Let's do this one kind of as a speed round, and I'll only throw it to Matthew.
Oh,
Unless
good.
Nick and Zach, you have something kind of quick to add. I want to get to a few more scenarios. So Matthew, I'm a developer owner, and I need to start building again now. I have land in a secondary market that was not overdeveloped in the 2010s. How much can I expect to be able to borrow, and from whom? From a bank, local lender, debt fund? And can I borrow based on 100% of the construction costs? And my equity is just the land?
Yeah, so a couple of qualifying things. I'm going to make the assumption that all your permits and approvals are ready to go. This is shovel ready. Makes a big difference. Then I've got a really good idea about a piece of land in the secondary market. That's not a deal. That's an idea.
Ready to go.
So look, it depends on a number of different things. I don't think you can take the percentage of costs in terms of construction debt in a vacuum based on what the percentage to what the development cost is. I think what you have to look at, and what we look at on a continual basis, is how much is it going to cost to build? What does the fill up look like? What does the takeout scenario look like from a cash flow perspective? And all of those things go into determining what your maximum loan to cost will be. Generally speaking, and Nick and Zach are probably better equipped to answer this, but for non-recourse financing, it's probably closer to 50 or 55% than 60 to 65%. I think that, we've touched on this earlier. The lending environment is more liquid than it was 6 to 8 months ago. Our conversations with local banks and regional banks suggest that there is balance sheet capacity to get back into the construction lending environment. Recourse is something that when somebody originates a loan 5 or 10 years ago and it was on a non-recourse basis, most developers that I've spoken to only want non-recourse debt. And who wouldn't want non-recourse debt? I will tell you, conviction and the ability to sign on a recourse perspective has a meaningful difference to what your spread is as you're building up your cost to develop. But I would say, generally speaking, on a non-recourse basis, it's probably something with a 5 in terms of loan to cost. And for a recourse, it's probably something with a 6. What I would suggest is that there's probably 3 different types of lending entities. There's a regional bank that you don't have a relationship with. There's a local or regional bank that you do have a relationship with, and it's a positive relationship. And then there's a debt fund. Again, as I talked about earlier, the debt funds are probably going to be the highest cost of capital. They're probably also going to be the highest amount of proceeds, but you will pay for it. So in answer to your question, Ben, the likelihood of your highest percentage of loan to construction costs is going to be a recourse scenario with a relationship bank that already knows who you are. But I'll defer it to Nick and Zach on this.
Yeah, I mean, to Matt's point, I think that we've definitely seen that leverage has come in pretty significantly on new construction, if you can even find bank financing for it. And with that, there's been some opportunities, particularly for us, to provide either preferred equity or mezzanine financing. I mean, we're selective when it comes to new construction, but some of the deals that we've seen more recently have been tied up for quite a while. They're shovel ready. They can pull permits today, but it took a while for that bank financing to come through. And the bank financing that did come through has been at a lower attachment point than I think they were initially anticipating. And so there's a little bit of a gap between where they thought the senior debt was going to be, maybe even where the sort of LP equity was going to be, and there's sort of a gap that we've been looking at and attracted to, and are bidding on today. So,
Nick, anything to add?
No, I think the guys covered it really well.
All right.